When you watch TV and listen to the economic news, you might hear a word called inflation. You're probably wondering what kind of thing inflation really is. Now, let's see what is meant by inflation, and how it will affect your life. The term of inflation derived from the Latin word, inflare. It means, to blow into or inflate. It was first used in America in 1838 in reference to inflation of the currency. Inflation itself is the situation of increase in the general level of prices of goods and services. It is an economic phenomenon that occurs when the supply of money increases at a rate that exceeds the rate of growth in output. The result is price increases, which means you need more money to buy less stuff. Inflation can be caused by a number of factors, but it's usually because there isn't enough demand for goods and services to match supply. When this happens, prices are driven up to adjust for the imbalance. Inflation can be either good or bad for economy. It can be good if the numbers are small enough and at steady level, so the economy can grow. But too much inflation can lead to high levels of unemployment and long-term economic stagnation. Based on the triangle model that introduced by American economist Robert J. Gordon, inflation generally falls into one of three categories. First one is demand pull inflation. This type of inflation is the kind of inflation that caused by increases in aggregate demand, as a result of increased spending in private and government sector. The demand pull inflation helps economic growth by stimulating investment and expansion, due to excess demand and favorable market conditions. The second one is the cost push inflation. This type of inflation happens when there is an increase in the price of raw materials, such as oil or food, that can't be passed on to consumers by producers. The third one, the built-in inflation. It is a type of inflation that stems from past inflationary events and persists in the present. Usually in the past, there has been either persistent demand pull inflation, or large cost push inflation. Then, that situation considered as a normal aspect of the economy. The simple explanation of this is, when workers expect wage increases in order to cope with price increases in their daily needs. If the wage increase are successful, the costs borne by their employers will eventually rise. The employers then pass on the higher costs to consumers in the form of higher prices so they could protect the true value of their profit, or meet their return on investment. Now we talk about the impact of inflation itself. Is it good or bad? In the United States, economists use indexes such as the CPI or Consumer Price Index, which measures the change in prices paid by consumers for housing, food, and fuel. They also use the Personal Consumption Expenditures or PCE, a price index to determine how much prices change over time. When inflation rises, dollars lose value. As a result, people have less purchasing power and must increase their incomes to maintain their standard of living. Assume your monthly take-home pay was $5,000 in July 2012. To maintain your standard of living in 2022, you must earn $6,352 today. That's a 27.04% increase in just 10 years. But then, can inflation be a good thing? Surprisingly, the answer is yes. While inflation may reduce the purchasing power of your dollars over time, many economists generally believe that a low and consistent level of inflation is required to drive economic growth and keep people's purchasing power stable. The Federal Open Market Committee believes that a 2% inflation rate aids in meeting those mandates. This level of inflation allows households and businesses to make financially sound decisions about saving, investing, and borrowing money. The Fed is responsible for maintaining a healthy level of inflation by adjusting the country's money supply and interest rates. When the economy expands too quickly and inflation rises, the Fed will typically raise interest rates or sell assets to reduce the amount of cash in circulation. This will increase the cost of borrowing money, slowing economic growth and lowering inflation. A steady and moderate level of inflation is good for the economy. And it can also help regular consumer, These 3 scenarios below outline who benefits from inflation. Number 1. The people with fixed-rate debt. Inflation can help you if you have fixed-rate debt, such as a mortgage or a student loan. Notably, if you have interest rate below current inflation rate. For undergraduates, federal student loans have a fixed interest rate of 4.99%, which is less than the current rate of inflation. The cost of borrowing money to pay for college decreases when the rate of inflation exceeds the interest rate on student loans. If you have a fixed-rate mortgage with an interest rate lower than the rate of inflation, the value of your debt is decreasing. Inflation somehow could also raises the value of your home. The average 30-year fixed-rate mortgage interest rate fell to 2.8% in 2021, well below the current inflation rate. As inflation and prices rise, the value of your mortgage decreases, assisting in the improvement of your financial situation. Number 2. The homeowners who rent their property. When the purchasing power of money falls, people will pay more for housing, implying that inflation raises the value of property. Inflation raises the cost of land, materials, and labor for new home construction. This will reduce new construction while increasing the value of existing homes, increasing demand and benefiting home prices even more. Therefore, people may think twice to buy or build a new house. Instead, they will go for the cheaper solution for their housing problem by rent a house or apartment. And that's why the homeowners will benefit from this situation. Number 3. The stock market investors. Inflation can benefit investors in the stock market. But it's important to remember that some stock market sectors benefit more than others or otherwise. In general, companies that can raise their prices in line with inflation will benefit, while those with inelastic pricing will suffer. Companies that selling non-essential goods may experience a revenue decline due to the rising of inflation rates, as consumers put the brakes on their spending and divert it to more essential needs, result in a decline of their revenue and share price. While on the other hand, energy stocks typically will benefit from the rising of oil prices. After we know what inflation really is, and what effect it has on our lives, you might think, then how do we deal with this silent thief? When inflation is rising at a rate higher than normal, here are steps you can take to protect the purchasing power of your dollars. To reduce the impact of inflation, examine your spending and identify areas where you can cut back or eliminate completely. It will free up money for investing, allowing you to be better prepared for the future. Inflation causes your savings to lose value over time. To protect against inflation, you should put your money in the stock market. If the prospect of investing scares you, consider a diversified portfolio of index funds to reduce your risk. The main issue with inflation is that the money you earned in the past to purchase an item is no longer sufficient to purchase the same item today. As a result, in order to maintain the same standard of living over time, you must earn more money. You can look for other sources of additional income by looking for jobs that require your expertise on the internet, without quitting your primary job. There are hundreds, if not thousands, of different types of jobs and gigs available on the internet that you can use to supplement your income. Who knows, your side job could provide you with substantial benefits and enable you to outperform inflation in the long run. If you like our video, don't forget to hit the like button and subscribe to our channel. Thank you for watching.